Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, the best podcast in the history of Cabot Wealth Network. We're going to get into a lot of topics today, but first, Brad, there's something we just have to address that you just told us before we went live. You are currently spending your weekends operating concessions for the Kansas City Royals spring training at the Kansas City Royals spring training facility there in Arizona. Explain.
Uh, so not just the Royals, but the Rangers, they share the spring training stadium in Surprise. It is, I don't know, it's a little bit embarrassing that after the D-backs lost the World Series, I have to serve the opposing team's fans nachos and tacos as part of a fundraiser for my daughter's choir and performance troops and the arts at her school. Um, she gets to go to Disney for a weekend with, parent accompaniment and teachers and stuff to perform at Disneyland, and they get to hang out at the park. So hopefully it'll be a good memory for her. But yes, I went to food safety training a couple of weeks ago. Unrelated, I got food poisoning immediately after going to that training. And then I worked the Oregon State NCAA game last weekend, and I have two days lined up in mid-March where I will be slinging hot dogs and tacos and nachos to hungry and thirsty fans. But it's a good fundraiser, a good cause. I've worked food service before. I can't complain that much. My daughter gets to go to Disney with her friends and not me. So
We need to clip this segment and send to our Jacob Mintz in particular, who insists you're the Forrest Gump of Cabot. Just have done it all. This just adds to the mythology.
So the one thing that I keep thinking about that Jacob has not heard is about the time that I wrote a bull, which I will not get into now. But if
Yeah,
he wants to
let's save
bring it
that
up
for
next time he's on
next
air,
time Jacob's on. Yeah,
uh,
we'll reveal all.
yeah,
Okay, so yeah, a smooth transition from slinging hot dogs and bull riding. Tell people what we have on tap for today.
well, we are on an abbreviated week coming off the President's Day holiday, and my co-host will be out on Friday, so this record will be dropping a day early. But partially because of that, and partially because it's literally the only thing that Wall Street is talking about this week, we're going to be covering Nvidia's earnings. Obviously, we're also going to talk about Amazon's addition to the Dow, whether that means anything for Amazon or for investors. And then we're going to talk about the Discover acquisition by Capital One and whether it's investable, whether it's meaningful, and what some of our takeaways are there. We will be foregoing a big breakout segment, again, partially because of that abbreviated week, and so that we can give NVIDIA the attention that it deserves. But before we get into that, Chris, it is your turn this week to defend the hottest take you can think of. And this week it is that the markets are hitting a short-term top and will not set new highs until the second quarter. You have 90 seconds and you can begin now.
This became a much hotter take since Nvidia reported earnings yesterday. I think I came up with this idea yesterday morning, I believe it was, Brad, and where markets, it's sort of been in a little bit of a doldrums or sluggish for the past 2 weeks. Well, Nvidia changed that. S&P is up 1.6% today as we speak. NASDAQ a little more than that. S&P actually is hitting a new high as we speak. It's slightly above its top from about a week ago on the 15th. So it seems like there will probably be a new high, at least in the S&P today, although the NASDAQ is still below its highs. I think this will be the peak until the second quarter. Yes. Clearly anything Nvidia does drives the market up. So if they do anything spectacular in the next few weeks, it has the potential to send stocks even higher. But I think this will sort of be this one day push right after their earnings will sort of act as like a ceiling for the next, couple months. I don't think stocks are going to tank, but I do think we're sort of a temporary top the next couple months. We saw this pattern last year, where big start to the year, January, February, way up after a big rally starting from October bottom, and then it sort of fizzled in March, April before getting going again. I think we'll follow a similar pattern this year, and I'm probably up against my time.
And you are.
Okay.
Yeah, as much emphasis has been on Nvidia this week, it does beg the question of what like the next catalyst is,
Yeah. Yeah.
right? And I mean, I don't want to diminish how much you are Babe Ruth calling your shot right now. This is very much a hey, the market's nearing all-time highs once again. Nvidia's up 15% today. But no, this is it. This is the peak. And, you know, historically a fool's errand to call tops and bottoms,
Yeah.
but it does beg the question of what's going to keep moving it higher.
Exactly. Yeah, just some stats. Actually, it's the last. So yeah, last year I mentioned October 10th. Actually, October 10th, 2022 was the market bottom after, you know, a horrible year of the market. From that point until the end of January, S&P was up 15.4%. It took more than 3 months for it to get back to new highs. So didn't happen until really the beginning of May. The pullback was only about 6.6%, but the market was not in as good a place then as it is now. So I think 6.6% I think that's higher than what we'll get, or sorry, more of a pullback than what we'll get in the next couple of months. But we're up 22% since the October 27th bottom. Like you said, it's betting against this market is a bit of a fool's errand. But you know, I think things have been sort of stagnating for a little while, and I think this big run up today from Nvidia is probably just a 1, maybe 2 day reaction, and then things will settle again. And like you said, not any obvious catalyst coming up. The Fed's not going to hike. Doesn't seem like the Fed is going to, sorry, cut rates until probably at least May. Now, I'm not saying it'll be until then that we'll have to wait for new highs, but I think it'll take a couple months. So we'll
Yeah,
see. I could
it's
look like an idiot a week from now, which wouldn't be the first time.
Yeah, it's so a couple of items before we really dive into the Nvidia earnings that are worth piggybacking on right there. One of which I mentioned Nvidia is up 15% today. They're up 7% since before that little spout of skittishness this week. You know, I think people are obviously concerned about the valuations there, and we will get more into that later. But you talk about the expectation for Fed cuts. There was actually an interesting line that I saw from a JP Morgan analyst, Marco Kolanovic, where he called what we're dealing with now the platinum locks scenario. So like a more valuable Goldilocks scenario.
Yeah,
And you know, it's something that Tom Hutchinson, with this dividend investor and income advisor, has been writing about, which is like, hey, the Fed can't really cut rates if the economy's humming on all cylinders and employment is really strong, right? Like those are two sort of competing elements that do not lend to one another. It's either the economy's weakening and you need to cut rates, or the economy's humming and you can't afford to cut rates. So
yeah,
I do think that there's a lot of elements that are sort of under the surface right now that that could make it tougher for stocks to just continue roaring higher. I mean, even the bullish price targets um, on the street are you know, S&P at 5,400 from Yardini, S&P at 5,500 from like your Bank of Americas of the world, and that's, you know, 9% higher through the
hmm
rest of the year. So
five
we've
zero
sort of
six two right now, S&P.
yeah, so we've claimed a good chunk of these sort of anticipated gains for the year already. Certainly not all of them by any means. Um, and you know, I'm not betting against it. I've learned my lesson on
Yeah,
betting against Nvidia or trying to call tops there, but I think you can make a very reasonable case that there's some digestion and choppiness ahead, and there's certainly yellow flags are out there that I know Jacob Mintz, aforementioned, and Cabot Options Trader Pro, Cabot Options Trader Analyst, has been looking at, and that even Mike Santolo has flagged to some of his readers as well.
yeah. Yeah, let's get into the Nvidia earnings a little more. That was number one in our big three. This is Nvidia's world. We're just living in it, or at
Yeah.
least Nvidia's market. It is responsible for 30% of the market's gains so far this year. Granted, that's less than 2 months, but you know, the market's up more than 6%. S&P at least is up more than 6%. 30% for one company. You know, we talked a lot about the Magnificent Seven driving things last year, and then you, I think, a week or two ago, talked about it's sort of been whittled down to like three:
Yeah.
Nvidia, Amazon and is it Microsoft? Or no, not Microsoft. There's
Yeah,
one.
it's there was there were a number of them. There was like the AI3, the M&M, the Microsoft,
Yeah.
Nvidia, Meta was the third.
Oh, Meta.
Um,
That's what I'm thinking of.
the
Yeah.
Magnificent Two and like underperforming Five. So there's a lot of sort of narrative, a
Yeah.
lot of people trying to be clever around it. But yeah, I mean, certainly it's a Magnificent Six now based on what Tesla's been doing recently. But if it's responsible for
Yeah.
30% of the gains, it does sort of beg the question of why buy anything else, right?
Yeah.
I mean, if we're all going to live or die on Nvidia, why not just own Nvidia? Um,
Yeah.
so
And the
what?
numbers, I think, I'm not sure you mentioned this yet. Income up 769% in the quarter, and revenues up 265%. Hence the 15% run up in the stock and dragging the market along with it. Um, AI is real, and Nvidia is clearly the leader there right now.
Yeah, so diving further into the numbers, earnings were 516 a share versus 4.64 were the projections, but there was a lot of sort of whisper and chatter ahead of the report that was looking for closer to $5 a share in earnings on 22 billion in revenue. And some of that was based on some of their sales projections and what their order book had looked like. But revenues even beat that, came in at 22.1 billion. Like you said, that's up 265% um, since the last year. They're projecting the current quarter, which was really the big driver, at 24 billion. And their CEO Jensen Huang came out and said fundamentally conditions are excellent for continued growth, sort of pushing, all the through 2024, probably out through 2025. So they really did they hit and beat expectations. Income of 12.29 billion, that was up 769% versus the year ago quarter of 1.41 billion. And part of that's due to their asset light strategy because they really are designing chips more than they're actually the foundry arm of things. Uh, the big winner is their data centers. Microsoft, Google, Amazon, Meta, the other Magnificent Seven companies, right? They're spending 10 billion a year on data center chips coming from Nvidia. Um, and it reminds me of decades ago when I was building computers as a high schooler, buying like Nvidia graphics set chips. Their gaming arm, their sort of their consumer chips are they're still a multi-billion dollar contributor, but they're really just being dwarfed by all the growth in data center. So they're almost a different company, at least from an investment standpoint, than they might have been even a year ago. And that's part of why they did 90% of last year's business in one quarter.
I'm going to gloss right over the fact that you built computers when you're in high school, but I've clocked that, and we'll just add that to the tally. But I guess my question is it healthy for the market to be this sort of dependent? Maybe dependent's too strong a word, but uh, weighted by one company. The company's doing great, but that can change. Is this healthy?
No,
No.
I wish I could qualify that a little bit better. But no, and part of the reason that it's unhealthy is that you then have like this asymmetric risk that presents itself.
Yeah.
So Nvidia's already had to struggle with their ability to export to China, and they're working with federal oversight on getting stuff that is sort of Chinese compliant to continue to sell into the country, and I think they were bullish in their commentary about that. But you've also got uh, Google manufacturing its own AI chips, right? It's when your four biggest customers are spending 10 billion a year, and that's like, 15% of your total annual revenues, you're just too leveraged to any one customer, which is a risk because
Yeah.
part of the risk with the asset light strategy is like, okay, yeah, you've got the bleeding edge tech right now, but if it's not critical that we use you because you have this production moat on top of your intellectual property moat, well, what's to stop a smart competitor from coming in and out designing you on chips, right?
Yep.
There was an interesting article about um, researchers using AI predict to predict plasma flow in fusion reactors that allowed them to stabilize it and could potentially be a big breakthrough. What's to stop somebody that's particularly smart using NVIDIA's own chips to use an AI to design better chips, and then the next gen of chips becomes way more desirable? IP is great, but it's less of it's a shallower moat, we'll call it, than something like really robust infrastructure that takes a long time to build out.
I guess the one devil's advocate thing I'll say is, and NVIDIA is benefiting from a big trend, and which is AI, and that trend is lifting all boats, not just NVIDIA. I mean, NVIDIA is steering the ship clearly, but I think AI, it seems like AI is strong enough where even if NVIDIA itself weakens, I don't know that the entire AI ecosystem will collapse, or AI related companies, at least AI leaders, Microsoft, others, will totally collapse. But it isn't healthy just how dependent the market is on one company right now.
No,
Um,
but piggybacking on that devil's advocate element, it like if you came to me and said, "Hey, I really want like 30% of my portfolio in AI," um, I'm just going to buy Nvidia, right? They're the clear
yeah,
leader in the field.
yeah,
They're selling picks and shovels in the new AI gold rush. I'm a research scientist. I firmly believe that AI is the wave of the future. What we're seeing is just scratching the surface. The stuff that's actually happening is way more impactful potentially and way more monetizable. I want 30% of my portfolio in AI and I'm just buying Nvidia. Yeah, okay. I don't have a huge problem with that.
yeah.
Personally, that's too much company specific risk for me, but you can make a case for it.
Yeah, there are others, smaller companies that are sort of later to the game in AI, or at least Wall Street is recognizing them later, that are getting a huge bump in the last month or so. Palantir,
You know,
PLTR, Supermicro Computer has exploded. I think SMCI is the ticker symbol, and plenty of other examples. So, but Nvidia is the clear leader at the moment. Okay, let's move on to number two, the big three. Speaking of mega cap tech stocks that have been leaders for a while. Amazon just joined the Dow. Not the most Dowish stock, which I
yeah.
think is the point, at least from the Dow's perspective. You wrote a good piece on this yesterday. Um, what's sort of who benefits more from this, or is this more just a speaker at a graduation getting an honorary degree?
Yeah, that's a decent way to put it.
Yeah,
So the rationale behind it was Dow is booting out Walgreens Boots Alliance, which is completely deserved. Stock's down 65% since it was added to the Dow in 2018. Peer Rite Aid filed for bankruptcy last year. Walgreens has been talking about trying to spin off its Boots arm, which is their UK pharmacy unit, which is a headache for S&P Dow Jones, who manages the Dow Jones index, because if they're doing spinoffs, you then have to like revalue the position, reassess whether it belongs anymore. You can't turn it to the Dow 31 because Walgreens spun off Boots and now Boots is is a separate company. So they sort of get ahead of that. The other element was Walmart's price split, their share split, their 3-for-1 stock split. The Dow is a price weighted index, which is part of why nobody invests in the Dow and index funds aren't really pegged to it. So what that ends up doing is it scales back the Dow's exposure to consumer retail spending by about 2/3 just because of an accounting trip that essentially triples Walmart shares, right? It doesn't change the business model, it doesn't change their market cap. So they needed a consumer retail spend replacement. And, Amazon, we've talked before about Amazon generating plenty of revenue from video streaming, ad serving. Amazon Web Services is a big revenue driver for them. So it doesn't seem like necessarily an ideal fit to replace a lost consumer spend, right? I would, if I was just trying to capture that, I would probably go with somebody like a Costco.
yeah,
But the one thing that Amazon has is the e-commerce element because they own about 38% of online shopping, and that has been growing really, really rapidly. So since 1995, annual online spending has increased at a pace of about 7.6% a year. It's been taking share from in-store shopping, and it's a feather in the cap for Amazon. It's an acknowledgement that not only is shopping online, but they're one of the primary drivers for that. But when it comes to investors, it doesn't really matter.
Yeah. I mean, it's so I think one of my defend takes late last summer was that the Dow was a better gauge of what's actually happening in the market. This was amid, the height of Magnificent Seven influencing there being a disparity between both the Dow and maybe more the S&P equal weight index and the actual S&P because of the heavy influence of the Magnificent Seven. Well, now one of them is part of the Dow, which maybe makes it more of an accurate gauge because the Dow before didn't really have, Mag 7 exposure. Now it does. Um, and so I think that might make it that it's not, so that it's not lagging, you know, what the S&P and NASDAQ are doing as much as it has been in the past, which could make it maybe more reliable. I don't know. It's one company, but it's only, Dow's only 30 stocks.
I mean, so Microsoft is one of the Dow constituents.
Sorry. Yeah. Yeah.
So like there's some Mag
But probably
7
the
in there.
least sort of exciting of the Mag 7, at least in the newsy of the Mag 7. It's the most Dowish of the Mag 7. Amazon's more of a headline grabber, I guess.
Yeah, I do. I think your case is well stated. It does make it more representative of how the U.S. economy actually works. Um, but like I don't know. I mean, ultimately, it's a widely quoted number. The reason it's price weighted is because when the Dow was originated, it was too hard to calculate market cap every day. Like just didn't have computers that could do it, so you'd be manually reweighting what the performance would be.
Yeah.
Um, so it's very much a throwback index, but it does its best to try and capture what's happening with the American economy broadly, with the exception of transportation and utilities, which are both in the Dow Transportation Index. And I think that it does an admirable job of that. But for all of its successes in reflecting the economy, there's really no money tied to it. The largest indexed investment to it is the DIA, which is a $30 billion ETF. Aside from that, you've got a handful of mutual funds that are pegged to the Dow that are in the, tens of millions of dollars and not in the billions of dollars because it's really just it. I don't know. I mean, there's like the optimism in America and an invest in America thought process could maybe justify investing in the Dow, but from a quantitative standpoint, it's like it's not giving you diversified exposure to different sectors. You can't really hedge. Like what if I have a big position in the Dow, you know, I'm
Yeah.
individually hedging every single constituent. So for that reason, it's not going to be a big driver for Amazon, but it's a pat on the back. It's a
Yeah. No, I
honorary
think the Dow
degree.
needed Amazon more than Amazon needed the Dow.
And
Like I said, it's honorary degree for Amazon, whereas the Dow sort of needed it to, get with the times a little bit more. This gives them
yeah,
sort of a a hipper feel or hipper in the sense of like, you know, uh, my dad turning his hat backwards, kind of that kind of way.
yeah,
It's
yeah,
not
and
actually hip, but they're trying.
it does make it better representative of the economy. I mean, like everything that we're saying about Nvidia and the growth of AI and how that's been such a huge driver, how companies are spending tens of billions of dollars. They're making $20 billion a quarter. Like that AI element, other than the Microsoft position, is not captured. That innovative tech that is really driving the markets right now and could drive the economy. I mean, the monetization is still not totally there for AI, but the business spend is certainly there. Yeah, I think that makes it more representative. Now, will Nvidia ever join the Dow? like if AI 5 years from now is where the internet is now, I mean, like maybe Nvidia joins it, and then it's like and then the Dow 30 becomes like this cutting edge tech tech allocation. But for the time being, I think it's a more accurate, but probably a couple years too late representation of how consumers spend money and where they spend money, which is online.
Yeah. Yeah. Right. I still prefer the S&P equal weight index as a better true market gauge these days, but that's, neither here nor there. Okay. Last on our big three agenda, Capital One Discovery merger. Capital One bought out Discovery for $35 billion. It hasn't been approved yet. Might run into some regulatory concerns if Elizabeth Warren has anything to say about it, and others. Does this Discovery stock got a bit of a bump since the buyout? Discovery has always been the fourth of in a three-horse race for the top, really two-horse race, the top credit card company in the world. Visa, MasterCard has always been the two top dogs, the Coke and Pepsi. American Express, third, solid third. Discovery's always been fourth. Does this change that for them, and what does it do for Capital One?
So just for the ranking, American Express or Visa has 133 million card holders in like as far as U.S. households are concerned, or as far as U.S. individuals are concerned. 110 million for Mastercard. It's 49 million for Discover, and then 44 million for American Express. So
Oh, so
those
they
two,
passed. Wow, I didn't realize.
those two are pretty close on the number of card holders, but Discover is responsible for, at least as of 2022, only 4% of the total credit card transactions, and that distinguishes between credit card and debit cards. But only 4% of credit card spending was done on Discover. Um, Capital One they're a big issuer, I believe, with the acquisition of Discover. In the aggregate, they'll become like the biggest credit card balance holder, and I think they'll usurp JP Morgan Chase. I could be mistaken on that, but I have not been able to find the article that I was reading. Um, but I guess so, we talk about sports periodically. Like if you combine 4 quarters in a trade, you'd rather have the dollar, right? Like, you talk about trading like a superstar for a bunch of like role players. This does concern me a little bit if I'm a Capital One investor, that the sort of sum of the parts is not necessarily going to be better. The whole is not going to be better than the sum of the parts, because Capital One prioritizes higher risk borrowers. They've got their own overhang from their consumer loan balances that they carry. Discover is dead last in their fourth in a three-horse race for the total credit card transaction volumes, and Discover also has outstanding consumer loan balances. So you're combining higher risk borrowers with a less utilized credit card payment rail. So I think if this is not successful, if this doesn't result in, if this is not handled well, you could very much just see a bunch of higher risk borrowers on a less popular transaction network. Where I do think there is opportunity is if Capital One can make Discover more competitive with Visa and MasterCard.
Yeah,
Um,
I have some numbers, some more numbers on that. Visa, MasterCard, um, processed nearly $10 trillion in payments in the U.S. between them last year. Discover 550 billion.
no,
So this is what Capital One tends to do, is switching all of its debit volume there. Their growth has been, they've been pretty reliant on Visa and MasterCard. So this sort of gives them more of a in-house growth option. But that sort of illustrates the gap between Visa and MasterCard and Discover, I guess.
yeah, but the flip side of that coin is that there's a lot of market share to gain.
Yeah.
So
Yeah.
so assuming that this is approved, the Biden administration has been harsher in their antitrust pursuits than prior administrations. Um, That said, I mean, it's a vertical integration. It's not like you're combining MasterCard and Visa, where then there's one less credit card network to process payments, and it's like anti-competitive. That I don't think it raises quite the red flags that maybe some people might be concerned about or might opine. So I don't think that regulators shut it down because so many banks ultimately issue like Visa cards, right? It doesn't become a consumer risk in the way that a merger of equals between like Visa and Mastercard, or yeah, Visa and Mastercard would be. So I think assuming it passes regulatory scrutiny, if Capital One handles it well and can get buy-in from businesses, because Discover is accepted in like 200 countries nationwide, but
Yeah.
the number of domestic locations that accept Discover is significantly smaller than those that accept Visa or MasterCard. So they need external partners that are outside their control to sort of buy in on this. The way to do that is cut fees, make it cheaper. Visa and MasterCard have gotten tons of complaints about their ability to hike fees. Um, Visa's accepted everywhere. Everybody has Visa, so with vendors, unfortunately, if you want to accept Visa, you have to agree to their 2% or 3%, whatever their transaction fee is. If
Yeah.
Discover can come out and say, hey, we can do it for a quarter of a percentage point, or we can do it for 1% or something that is meaningfully more competitive, then maybe that makes them more attractive. And it hurts their bottom line a little bit because it's less of a revenue generator for whatever the new Capital One Discover conglomerate's going to be. Um, but if they can do it to get back sort of into the land grab phase, like we were talking about with sports wagering companies a couple of weeks ago,
Yeah.
if they can maybe take a little bit of a haircut and gain some market share and then normalize their fees, they could claw their way to like a respectable third place. I don't think they'll ever compete with Visa or
No.
MasterCard, but
Yeah.
from payment
Quick,
volumes, they could compete with American Express.
quick story on you mentioned Visa, MasterCard's just wide availability, pretty much anywhere you go, available. Discover not so much. I have a friend who this is years ago in his 20s, early 20s, who on first dates, he would always break out his Discover card. Not always. If he knew there was not going to be a second date, he would break out his Discover card and claim that that was his only card when the check came, because the Discover is not available anywhere, and be like, "Oh, I'm sorry, I would pay, but got the Discover card." It's a horrible thing to do, but it
Yeah.
just sort of illustrates how unavailable Discover. I've never had a Discover card. I don't know if you have, but how just it's just not accepted many places. So there is plenty of upside, that's for sure. In terms of upside for either stock, would you invest in either based on this deal? I guess Discover would be maybe more the bigger beneficiary.
So Discover is going to the terms of the offer are 1.019 shares of Capital One for every share of uh 1.019 shares of Capital One for every share of Discover. So they should trade roughly at parity. Right now Discover is trading at 121.84. Capital One is trading at 135.88. So so Discover is trading at a slight discount to Capital One. Um, that is probably coming from the regulatory risk, right? I personally don't think it's very significant, but
Discover is flat the last 2 years, the stock. Oh, and that's even after a big jump from this deal. 70% the last 5 years, but that's still not a ton.
so
Uh,
if you're a big believer, if you think the deal goes through and you're a big believer in it, the correct move technically is to buy Discover, and then you get the arbitrage where you hold those Discover shares waiting for them to be flipped to Capital One, because
yeah,
they're trading at an 8% discount to where they should be trading if the deal
right,
were to go through today. So there's
right.
a little bit more upside if you are a big believer in the new combo Discover Capital One. There's slightly more upside to buying Discover, but the two stocks are going to trade pretty much in lockstep as you get through like the regulatory review process, or if if there's a statement from regulators or something saying, yeah, we're not going to push back against this merger, then you would expect to see Discover to start trading closer to parity. And then it's just a matter of the arbitrage trade being a time value thing, because if you were a Discover shareholder before it popped after the announcement, when it was trading at 110 on last Friday. It's up to 120 now. It should be trading closer to like 130. So that's a time value element. If you're not inclined to wait for a year, maybe 18 months, it could take that long for a
Yeah,
merger like
it'll
this to
take a
go
while.
through. So you get paid a little bit for your time, but not a whole lot. You would probably make more money just sitting in like treasuries.
Yeah,
But if you're a believer in it, the correct move is to buy Discover. I think you can make a case either way. Like I said, if Capital One handles it really well, then yeah, they can claw back some market share from the two big boys. But I think the risk is, and especially if we get into a recession or something like that, with credit card charge-offs starting to rise, the Capital One and Discover cardholders are higher risk borrowers. Charge-offs are going to be higher with them. Um, so I think like the recession risk is probably outsized for investors that are banking on this merger. Um, I don't know. I like personally, I probably would not. It's still too early for me to like bet on it with a lot of conviction.
yeah.
Um,
I would
I
just
would,
invest in Nvidia.
yeah, just put everything in Nvidia.
Yeah,
Um, no, but I would want to see something from Capital One about how they plan to handle the post-merger company going forward. How are they rebranding? What's their strategy for appealing to businesses to get their cards accepted in more places? Uh, what are they doing to mitigate the risk of their higher risk borrowers? Right. I would want to see the business plan more fully before I would dive in with both feet. It I mean, like the Capital One, their commercial strategy seems to be pretty good. The commercial broadcasting, not commercial lending strategy seems to be really effective. Certainly, we see Capital One everywhere.
yeah, it
Um,
is. Those the Charles Barkley, Sam Jackson commercials. Is
yeah,
that the
and
one?
like
Yeah,
Jennifer Garner, I think has one, and like the What's in
yeah,
Your like if you think that the success they're having there is emblematic of the success they could have post merger with this company, and you think they can make the same kind of impact, yeah, I think you could make a case for buying Discover and hoping all goes well. But I would want to see more concrete steps that they plan on taking to really claw back market share. I would want to see, promotion, like announce a 1 year promotional rate waiver or something like that. Hey, or like, tell businesses our standard fee is going to be 1.75%, but we're going to waive 0.5% of that for the first year after you start accepting Discover. Right. Like the promotional stuff that works on consumers will work on small businesses too, more so than the big companies. Big companies want stability more than they want to save 1.5% for a year. But if you can get more people to accept Discover, and you can combine the two outstanding credit card consumer loan balances and the business book and become like one of the biggest credit card issuers in the country, I think that you could potentially get to success. I just want to see more concrete evidence of that and maybe a more explicit plan.
all right. Yeah, we've probably said enough about Capital One and Discover at this point. At least for 1 year. But well, that probably is how long it'll take for the deal to go through. Um, okay, so let's go ahead and wrap things up. As always, if you're watching on YouTube, subscribe, 5-star rating, hit the like button. Um, and if you have any questions, comments, or more interested in to hear more about Brad's hot dog flipping career, um, email us at streetcheck@cabotwealth.com. And thanks for joining us early this week. We will be back at our usual day next Friday next week. And it'll be March, which I'm very happy about here in Vermont. Any final words, Brad?
No.
There we go. We'll see you next week. Thanks for joining us.